All investors love a good story. They like to hear about how directors are taking a business, expanding it, and making all sorts of promises about where shareholders will be in a few years' time. The trouble with stories is, if you're an investor, they need testing. It's no good just believing a story, even if it's a very well spun one, because basically businesses need to make money, and as a shareholder you need to see some income or some growth. As Lord Csurgo once said, it's all very well setting up a business, selling £10 notes out in the street for £9 each. You'll sell lots of them, but you'll go bust. So what do investors do to test the story? In other words, how can you be convinced that when you buy a share, you are getting good value for money and you're not just buying into a load of puff, if you like? Well, that's what this video is all about. 6 key numbers. Now, straight away, when I say numbers, a lot of people will be turned off. Give us the story, Tim, tell us the interesting bit. You've got to get to grips with at least some basic numbers, otherwise forget investing. Okay, so what are the 6 numbers minimum that every investor should know? Now when I say know, I don't necessarily mean be able to calculate from scratch. What I mean is at least understand what the number is trying to tell you and why it's important. There are arguably more than 6. Not everybody will agree with my 6, but this 6 is a very, very good platform, and you'll see these ratios scattered throughout various Money Week publications. So it's important to have some understanding as to what they're trying to say. Now, the other thing to say about this video before we start is that it links to other videos. So each of the ratios, the magic numbers I'm going to mention, has its own video. So for anyone who finds this one a little bit quick, do feel free to just dive in to those other videos as I mention them. So this is a roadmap really, as almost to why, as an investor, these 6 numbers are pretty key to your success or otherwise. Okay, so if I buy a share, just a reminder, what am I doing here? What am I looking for? All right, well, arguably, I'm buying for one of 3 reasons. Growth is a fairly obvious one. Hopefully the value of your shares goes up rather than down. So you're looking for capital gains and you're prepared to wait to get them. The other reason is income. And the third reason I'll call perks. Now, by income we mean dividends, and we'll take a look at a couple of key numbers in a moment that tell you whether or not an investment is a good dividend buy. Perks, let's deal with those first because we're not going to say too much about those. Perks is the fact that if you buy certain shares, you don't just necessarily get a capital gain and or some dividend income. You might get a discount on travel at a certain point in time. Eurotunnel shareholders, for example, got a discount on the price of tickets. You might get cheaper utility bills. You might even get free chocolate, depending on which share you buy. And of course, all shares, every single one, come with the right to turn up at the annual general meeting of shareholders, speak and be heard, as the law puts it. And more people should make use of that. Sure, if you turn up at a shareholders general meeting where the directors are present, you will probably get outvoted on anything you say by the big institutional shareholders. Nonetheless, you are allowed to table basically comments at that meeting on, for example, directors' pay. And more people should. That's another perk of being a shareholder. Not a perk you get if you own IOUs called bonds. Bondholders don't get to go to these annual general meetings. So for some people, those perks are significant. They're not to be dismissed. But as an investor, looking purely at making money, these 2 are the more important. And this is where the magic numbers come in. Now, as I say, you don't need to be able to compute these from scratch. If you'd like to be able to do that, check out the other videos that I refer to as I go along. More important is to understand why the number matters and what it's trying to tell you. So let's start with income. Basically, income means dividends. The directors determine what dividend they're going to pay, and then shareholders sort of ratify that at annual meetings and so on. So ultimately, this is the directors sitting down and saying, well, we've made a certain amount of money this year as profit, we're going to pay some of that out as a dividend, and we're going to keep back the rest to try and grow. So there's a natural trade-off. Companies that are generous with income tend to grow less quickly. Maybe think about your typical utility companies in that basket. Companies that are less generous with income have more money to reinvest and tend to grow more quickly. Classically, the kind of tech stock position, if you like. Dividends then, two questions really that an investor wants to be able to answer, and two ratios that answer them. What is my income return on this stock? And that's known as its yield. Now, there is a separate video, little V in brackets, on dividend yields, how to calculate them and monitor the pitfalls. But in principle, you want to know the income return as a percentage on your investment. Is it, for example, 8%? How does that compare with a bank account? How does that compare with a bond, which will generate income? In other words, what sort of annual income return am I getting? Maybe you even compare it to property, which also can give an income yield if you're doing buy-to-let. Okay, so that's a fairly crucial number, and dividends impose discipline on management. The fact they have to keep paying them every year is good news, and therefore some investors invest exclusively for dividend income. After all, since the mid-1920s, roughly half of the total return from the S&P 500 has come from dividends. The other question though is a safety question, and there's another video on that one. How safe is your dividend? How many times is it covered by profits? The more times the better. And that simply says, right, we had 100 million of profits in total this year, we paid out say 10 million as a dividend, we could have paid that dividend 10 times. So cover was 10 times. The higher the better. Low cover, bad news, because it means the yield you've just been paid or just been offered may not be repeated in future. In short, if that's high and that's low, you might be looking at what we call a dividend trap, and you don't want to fall into one of those. Okay, that's income. What about on the growth side? What about if you're prepared to sacrifice income to get growth? Well, two ratios that go together: earnings per share and the PE ratio. Now, in a nutshell, earnings per share is the key to the PE ratio, and once again, not surprisingly, there's a video on that, and there's a separate video on that. So if you're getting lost, feel free to jump to those videos right now. But basically, earnings per share, what total profits per share did the company generate this year? The higher the better. And what's the relationship between the current share price and that figure? In other words, how many times is the current share price 1 year's earnings per share? The more times, basically the more expensive the share. So if you're looking for a bargain, you don't want high PE ratios, you want low PE ratios. And low PE ratio with a high yield, exactly the kind of profile that some people want, because they're saying, well, I'm getting decent income and I'm not paying too much to get it at current share prices. But as I stress, have a look at my videos on those two topics if you're not sure. So I'm going to count that as 1, 2, 3. Number 4 is the price to book ratio. Now, basically, there's a video on what is a price to book ratio. This asks the question, is the share reasonable value from a slightly different perspective? This time, rather than comparing the current share price to earnings per share, that's a profit and loss based sort of valuation, if you like, it compares the current share price to the book value of a company's assets. So on a kind of asset basis, is the current share price decent value or not? And if you can look at both the PE ratio and the price to book ratio and conclude that both are low, with a price to book less than 1 is a good start, you're starting to get well down the track of saying, well, basically I'm getting this share at a decent low price, I'm not overpaying. Now, just a couple more I'd like to mention here. One appears a lot in Money Week literature and is a popular replacement for the PE ratio. It's known as EV EBITDA. Sounds ghastly, sounds like a real mouthful. Thank goodness there's a separate video on it. Please take a look at that one if you're not sure. But essentially what this does is to say, is the firm cheap by reworking the PE ratio. It replaces the share price with enterprise value. That's market capitalization and debt. And it replaces earnings with earnings before interest, tax, depreciation and amortization. In other words, earnings before financing costs and dodgy stuff, if you like. So for some people this is a superior measure of profits, 1 year's profits, and for that reason they like to base valuation metrics on it. Now again, someone watching this video or reading Money Week isn't going to want to go out and crunch all these numbers, but if you'd like to see an example of how that could be put together, check out the separate video. So what are we saying so far? We're looking for value on a PE ratio basis, a reasonably low or sensible PE, a sensible price to book valuation, ideally below 1, and we're also looking, compared to say sector and market averages and nearest competitors, a nice low EV/EBITDA valuation. Now, one more ratio worth mentioning. It's probably the least satisfying of the ratios, but it is worth a mention, and that is price to earnings growth, or PEG. And again, here's another video on that one. That's my 6th. 1, 2, those goes a pair, 3, 4, 5, 6. The PEG ratio basically sets the current PE ratio against the expected earnings growth rate. Now, as soon as I say expected earnings growth rate, some people will say, well, that sounds like a bit of a guesstimate, and it is, but that's quite a useful way of asking the question. Number one, are we expecting a decent rate of earnings growth from this business? And number two, is the share cheap or expensive looking at that earnings growth profile? So, it's not a perfect ratio, the PEG ratio, it has its critics, but it has its place too in this kind of assessment of, am I getting the company I'm buying at a sensible price? In other words, am I getting growth at a sensible price? Just buying growth, just buying a story isn't enough. The story needs to be at a price that makes sense. So yeah, sure, for a lot of people this is a lot of numbers. They prefer to just listen to the directors spout on about what a brilliant firm it is and take a couple of analyst tips, let's say. But if you really want to understand what you're buying, then you need to get a little bit further than the story, get into these 6 key numbers and try and build a quick snapshot picture as to whether what you're buying is a bargain or not.